All right, so our first step is I'm going to go back to Bloomberg and log in. And as I said, the company that we're going to use is SBUX, so SBUX, US Equity. And then what you're going to need to do when you reuse this model yourself for a different company and for your group projects is you're going to have to go to the FA screen, which has historical financial data. And again, it's organized into a series of subtabs. The first subtab is called IS, which stands for income statement. And you'll see that the income statement, this tab here below, shows that this is put into a standardized format. So this is what I meant earlier when I said that somebody at Bloomberg has gone through the 10K of a company and they have mapped it into the Bloomberg standardized income statement format, okay? Which unfortunately Bloomberg changes for non-US companies. So this primarily works well for US companies, and Bloomberg also changes the standardized format for non-industrial companies. So this works for service and manufacturing companies. The format's a little different for a financial services company or a bank, for example. So again, this is their standardized sort of industrial format. And you can also click here for as reported, and this would have been how SBUX reported it on their 10K. Okay? So again, that's the difference. If we just go to what companies report, we have to put square pegs into round holes. And it becomes more difficult because every time we change companies, every company has slightly different income statement data format. Every company has slightly different balance sheet format. But by using the Bloomberg data service and their standardized format, they have gone through and put everything into these standardized format tabs. So this is what we are going to use. Right? So since we're working in Excel, we have to get the data out of Bloomberg into Excel. So that's where we go up here and we click on Output. And in Bloomberg, you can output to Excel. So what I'm going to do is I'm going to dump all of this historical income statement data into Excel. Now, every time, and I do mean every time, you dump from Bloomberg to Excel, Excel gives you a security warning. And it basically says, we're getting data put into us that we don't really recognize as an Excel file. Is it okay? And you're going to have to say yes. And if you don't say yes, it will stop the process and it will not import. And I mention this to you sometimes because this security warning, if you have a bunch of windows open, can sometimes be buried behind a bunch of windows, and you'll think that everything is frozen, but it's just waiting on you to say yes. And every time you export from Excel, you have to say yes. Okay? So in this case, we're going to say yes, and it's going to basically dump in all of that data into Excel. Right? Now, here's another point. The reason that there's a security warning here is that if you actually click on these numbers, you'll realize they're not numbers. They're actually database lookups. So what's happening is Excel is using the template that we just downloaded to pull real-time data from the Bloomberg database and then fill it in here. So here's the problem. If I were to save this file, put it on a thumb drive or email it to myself, leave the lab, and I open up the Excel file and I'm not on the same machine with a Bloomberg terminal, then it'll just give me errors. I don't actually have numbers. Okay, so this is an important step because you don't have Bloomberg on your laptops outside the lab. So what we're going to have to do is convert this into numbers so that I can take this outside the lab. So what that really means practically is if I go up here in the upper left hand corner, if I select the whole worksheet, copy the worksheet, paste special values the entire worksheet, then it's going to basically overwrite everything with a number, just the values. So now if I go back to this, you'll notice that the database lookups are gone and I now have a bunch of numbers. Right? So that's going to be very important if you leave the lab. Right? Because theoretically what you could do, if you had Bloomberg on your laptop, is you could build a reusable model where all you did is type in the ticker symbol and it just always pulls down the data for that ticker symbol, but you'd have to always have Bloomberg open and available on your machines. So this is an extra step which says we can download it, take it out of the lab. So again, translate it into values. Copy, paste special values. And then here's the other thing, just as a word of warning, Excel, when we import, doesn't like the pound NAs, right, which means not available data in Bloomberg, in their database speak. So if you have a pound NA, we have to turn it into a 0. Because if we give a pound NA to Excel, it's just going to give us an error, right, when we do formulas. So what I'm going to do is do a find, which is a Control F. I'm going to look for all my pound N/A space N/A's, and I'm going to replace them all with zeros. And then I'm going to save my file. File, save as, and it's a web page. So I'm going to save it as an Excel workbook. Put it in my downloads folder here, and I'm going to call this SBUX-IS. Right? Now I'm going to do the same thing with the balance sheet. So I'm going to go back to the FA screen. I'm going to click on BS for balance sheet. I'm going to output to Excel. I'm going to go back to Excel. I'm going to wait for the security warning. Say yes. I have all my balance sheet data. Okay. Select it all. Copy it. Paste special values. So now I have all the balance sheet data. Historical. Hit Control F. Find all my pound N/A space N/A. Replace them all with zeros. Or 25 of those. File, save as, Excel workbook. Put in my downloads folder here, SBUX BS for balance sheet. And finally, the third statement that I'm going to need is the cash flow statement. It's the GAAP cash flow statement. Right? So again, output Excel. Back to Excel. Yes to the security warning. Right. Once finished getting all the data, and copy, paste special values. Make sure all those are numbers. Control F. Control F. Pound N/A, N/A. Replace those with all zeros. Okay, and then let's save this as an Excel workbook. And again, SBUX-CF for cash flow. Right? So basically, that's the raw financial data: the income statement data, the balance sheet data, the cash flow data. Now, in just a minute, I'm also going to need 3 additional screenshots from Bloomberg, so I'm going to go ahead and take them now. Right? The first is on the DES screen, stands for description. It's got summary data for the company, but on the first page of the description screen, DES, are the shares outstanding for the company. And when we do the valuation, we're eventually going to need to know how many shares they have, so I'm going to go ahead and take the screenshot just so I know how many shares Starbucks has. Right, just an easy way to find it. So, File, Export, Save Screen as File, and I'm going to call this SBUX-DES. Another thing we're going to need is the weighted average cost of capital. So I'm going to type in the WACC. This will give me their current estimate of their WACC. So again, we're going to have to discount the cash flows. So we're going to discount them at the WACC. There's the WACC we're going to use as a discount rate. So again, I'm going to take this as a screen, save screen, SBUX -WACC. And finally, we're going to need to know the earnings estimates on an annualized basis for Starbucks. So I go to the EEO screen, switch it to annualized data, file, save as SBUX EEO. Okay. So those are the 3 additional screenshots that you'll need as part of our evaluation exercise. All this is being recorded, and I'm putting in the names of the file the Bloomberg shortcodes. Okay. So you'll notice that in the files that I just downloaded, SBUX EEO, SBUX WACC, SBUX DES, cash flow, balance sheet, income statement. Okay. All right. So we go back to our SBUX folder. I'm going to take these files and I'm going to upload them. So here were the 3 screenshots. And here were the 3 Excel data files. So very shortly, there are now 7 files in that folder. And you'll need to download all of those files. All right, so as we build out the model. All right, because next what we're going to do is we're going to start taking that data that we just downloaded for Starbucks, and we're going to start putting it into our valuation model. Questions about what I've done so far? And again, I've recorded this so that you can refer back to this as you're working on your next homework assignment after the midterm. Because after the midterm, I'm going to give you another company and you're going to have to do the same thing. Right? And then for your group project, you're going to do the same thing as well. Questions? Okay. All right, so I'm going to go back to our Excel file here. And this is the valuation model SBUX Part 1. And I'm going to go back to the Data tab, which again right now has some Best Buy data in it. And here's what we're going to do. I'm going to take the income statement. I'm going to quit out of the other Excel that's in Windows. So quit out of Bloomberg and quit out of the Windows Excel. All right, so I'm going to open up the income statement data. I'm going to select the entire income statement tab that I just downloaded. I'm going to copy the whole tab. I'm going to go to my valuation model. I'm going to select the whole tab. And I'm going to, again, paste special values. And because it's mapped to the Bloomberg template, it's going to basically overwrite it field for field. And the data is going to be in the right place. Okay? Now, very important, don't paste. Don't copy paste between worksheets. If you copy and paste between worksheets, then what will happen is Excel will put relative references to the original worksheet. And every time you open the new worksheet, it'll say, where's the old worksheet? Where's the other SBUX-IS worksheet? That's why we do copy-paste special values. Because if you copy-paste special values, it doesn't paste the link to the original file. If you copy and paste, it'll put the link to the original file on there, which will cause you chaos later as you're trying to reuse the spreadsheet. So that's why we're copy-paste special values. So I just overwrote the income statement data for Starbucks into the model. I'm going to do the same thing with a balance sheet. So again, I'm going to go to SBUX-BS, copy it, paste special values. And then I'm going to go to the cash flow statement. Select all, copy, paste special values. All right. So I've basically just overwritten the income statement data, the balance sheet data, and the cash flow data for SBUX. All right. Now, two other tabs in the model that I haven't talked about yet that I'm going to mention now. One of them is the ratios tab, and the other is this tab which I'm on called the assumptions tab. These are going to be very important tabs in our valuation model. One of the things that we're going to do is we're going to make a lot of assumptions when we come up with our forecast for the company. And what we don't want to do is we don't want to scatter our assumptions all throughout our model, because it'll be too many places that we'll have to go search for to change things. So we want to kind of aggregate into as few places as possible the places where we're going to change things about the model. So one of the places that we're going to change things are called assumptions. And you're also going to see that some of the cells are yellow. So what we're going to do is we're going to use the concept of a color, and I've just chosen yellow randomly, to basically say if it's a yellow field, that's an assumption I can change. If it's not a yellow field, then it's an assumption I shouldn't change, because the model is going to have a lot of relative references in it and a lot of formulaic calculations, and I want to break those. So I have to distinguish in this very complex model we're building between what I can change and what I cannot change. And so therefore, things that I change, I'm going to use color to tell me that I'm allowed to change this. I'm not going to screw my model up if I change this, and I'm going to make that yellow. Now, one of the assumptions, so I want to do it as few places as possible, that we're going to aggregate is the last reported year. Right? So I don't want to use hard-coded references to the years, because as the companies have new data come out, I want the model to always be a relative reference to the years. If I change it, it updates the whole model. So in this case, I just want to look at my balance sheet, and I can see that my last reported year is 2013. And if I go to the SBUX balance sheet, I see that they have actually reported 2013 earnings. So I have a 2013 balance sheet. So right now I don't have to change the last reported year as an assumption. It's already 2013. But if SBUX had reported 2014, then I would change this to 2014, and then it would update the year. Okay? But right now the model's already looking at 2013. Second assumption that's there on this page right now is operating cash as a percentage of revenue. So right now, we're assuming that operating cash is 2% of revenue, which is basically 1 week out of the year. The rest of the cash will go into excess cash. Right? And that's just an assumption that we're going to leave for most companies at the start, and just say that all companies need at least 1 week or more of operating cash. So we're going to use 2% of revenue as a proxy for the operating cash level of the company. And finally, the third assumption on this page is the estimate for the weighted average cost of capital. That's the discount factor that we're going to use to discount the cash flows. So in this case, we're going to use the SBUX WACC to discount our cash flows. And right now that's 9.1%. So I'm going to change this to 9.1%. And we'll talk about the other assumptions in just a minute. Okay? All right. So here's the next step. Ratios. Ratios is a very important tab in our model. The ratios tab not only gives us historical financial ratios for the income statement and the balance sheet, but the ratios, per the reading in the book, is how we are going to forecast the financial statements of the company. So we're going to use the ratios to forecast the financial statements. Right? So the idea is, rather than forecasting the income statements and balance sheets directly, what we're going to do is we're going to use the financial statements historically to create these historical ratios. We're then going to forecast the ratios, and the forecasted ratios will give us forecasted income statements and balance sheets. Okay? So that's how we're going to forecast statements. We're not going to forecast statements directly. We're going to forecast the ratios. And what you'll find is that is an easier and better process than directly forecasting financial statements. Right? So that is the process by which we will start. Right? Now, as we build out our forecast, and we'll start out with the first year, 2014 for SBUX, I want to make this a reusable model. Therefore, wherever possible, I want to use what we'll call relative references. So what do I mean by that? That means my first forecast year is going to be 2014. 2013 and before that was historical data. So what I'm going to do is I'm going to say equals the previous year plus 1. I'll make that bold and underline just to match the formatting of the previous years. But I don't want to hard code the year because I want to make relative references so that if I ever change something, if I change the historical years, I want the future forecast years to update as well. Right, so again, equals previous year plus 1. Now, for revenue growth rate, for the income statement, this is change in revenue, which is basically current year minus previous year divided by previous year. Everything else on the income statement is pretty much a percentage of revenue, okay, with the exception of tax rate. So here's what we're going to do. For revenue growth rate equals the previous year. Right? So as a starting assumption, now later we're going to change this, but last year SBUX revenue grew by 12%, and we're going to assume in 2014 that SBUX revenue is going to grow by 12% as well. Right? Now again, this is a placeholder. We can change the forecast a little bit later, but for right now, equals the previous year. Right? I'm going to then take that cell and I'm going to make it yellow. Because that is an assumption that I may choose to change at a later date. Right? For assumptions, I'm going to do the same thing, equal the previous year, for most of these assumptions. So for revenue, cost of revenue equals the previous year. Make that yellow. For operating expenses equals the previous year. Make that yellow. For depreciation, amortization equals the previous year. Make that yellow. For tax rate, last year their tax rate was 103.8%. Right? I don't think that that's a realistic tax rate, even for the French, right? Which have probably the highest tax rate in the world. So basically, I think that I have to put in a reasonable tax rate. So what I'm going to do is I'm going to take an average tax rate for the previous 5 years. This again equals average of those 5 years. And I'm going to make that yellow. Right? Because I need to put in a realistic tax rate, and I'm just going to exclude the last year as an outlier and say I think 32%, 31.9% is probably a more realistic tax rate for SBUX on a go-forward basis. Next, I will take my net non-operating gains and losses, and again, I'm going to take an average of the 5 years, because I think 16% seems a little bit high. Okay. Now you notice I skipped some cells. And the reason I skipped some cells is that when we forecast a company's financial performance, we're going to have to make a choice. And what I mean by choice is that if we forecast cost of revenue, then 1 minus cost of revenue equals gross profit. So we don't really need to forecast gross profit because we forecasted cost of revenue. Same thing with EBITDA. 1 minus cost of revenue minus operating expenses equals EBITDA. So since I forecasted cost of revenue and operating expenses, I don't really need to forecast EBITDA again because it's a result of the other two items that I forecast. Right? So when we build out the model, we either forecast EBITDA or we forecast the components of EBITDA. Right? The choice that we are making in this model is we're going to forecast the components, and the components are going to give us the results. You could have done it the other way. It's not saying one way is better or worse. We're just choosing to forecast the components. Right? So what does that mean? That means my gross profit equals 1 minus the cost of revenue. My EBITDA equals my gross profit minus my operating expenses. My operating income equals my EBITDA minus the DA, minus the depreciation and amortization. Okay. So essentially I'm getting an operating profit or an operating income by subtracting EBITDA minus DA. I'm getting an EBITDA by taking gross profit minus operating expenses, and I'm getting gross profit by taking 1 minus the cost of revenue, excluding depreciation and amortization, which is going to be part of the DA, non-cash items. Right? So I've just forecasted the components. NOPLAT. I know NOPLAT is my operating profit times 1 minus my tax rate. So if I take my operating income and I multiply that by 1 minus the tax rate, that would get me my NOPLAT. So again, those are my, what I'll call my calculated results. My calculated results are gross profit, EBITDA, operating income, NOPLAT. I could have either forecasted them directly, but in this case I chose to forecast the components, which essentially got me each of those key items. Questions about what we just did? Hopefully pretty straightforward. Yes?
Well, during the past process in valuation, like teacher taught us how to do projection using the past growth ratio or something to forecast the new statement. So would that be still possible?
Well, right now what we're doing is I'm calling these a placeholder because once we build the statements and build the model, we will go back and change these assumptions. Right? So right now I'm just putting in simple assumptions equal to previous year just so that we can finish building out the model. But then, as I said, later we'll talk about how we actually change the assumptions going forward. Okay. So that's a good point. We will be changing these assumptions later. Right now we're just putting it in here just as a step to help us get the built out model. All right. So next step. I forecasted the key ratios for the income statement. Now what I'm going to do is I'm going to go back to that income tab and I'm going to start creating the forecasted income statement based on those ratios. Right? So here's what I'm going to do because there's a lot of data on the income statement. I'm going to separate out my historical data, just if I print it out, I know it's history, versus my forecast. So I'm going to label everything from this column forward as forecast. And again, first year equals previous year plus 1, relative reference, for 2014. Now, my first item that I'm forecasting is my revenue. Okay. So here's what we're going to do for revenue. I have forecasted on the ratios a percentage change in the revenue growth rate. Okay, there's a placeholder in there for that, 12.4%. So here's what I'm going to do on my income tab. Equals, for 2014, the previous year's revenue, times 1 plus the growth rate. So left paren, 1 plus, from my ratios tab, the revenue growth rate in 2014. And I'm going to take this entire column, format it, currency 1 decimal place, just to be consistent with the others. So if I have that revenue growth rate. That will be the revenue growth rate in 2014. Right? And again, this is the reason we're doing this. Don't do what I'm about to do right now. But here's the idea. If Starbucks were to grow at 9%, then that's what a 9% growth rate would result in. All right? So we're setting up the ability to make changes later, so it will adjust the financial statements. But, as I said, right now, we're going to leave it at whatever it was in the previous year, just as we're building the model. Okay? So that would be the revenue growth rate for 2014. All right? Next, cost of revenue equals 2014 revenue forecast times, from my ratios, cost of revenue as a percentage of revenue in 2014. $6.4 billion. And then you can see we're following the standard format of Bloomberg on the left. So revenue minus cost of revenue equals gross profit. Equals revenue minus cost of revenue. That's my gross profit. All right, so I'm forecasting a gross profit of 10.263.1 billion. All right. Next, operating expenses. I have that on my ratios tab. So equals 2014 revenue times ratios 2014 operating expenses as a percentage of revenue. So basically using that forecast to create the operating expenses as a percentage of revenue. EBITDA equals gross profit minus operating expenses. Again, following the formatting over here on the left. Equals my EBITDA. Depreciation and amortization equals 2014 revenue times, from my ratios, 2014 forecasted depreciation and amortization. Operating income equals EBITDA minus the depreciation and amortization. That is my forecast for operating income. So very quickly, we have created a forecasting model that will forecast the operating profit or operating income of the company. Okay. Now, yes?
I guess you use a wrong ratio to calculate the cost of revenue.
I used the wrong ratio for cost of revenue. H3. That says H3, which is 38.5%. So 2014 revenue times 2014 cost of revenue, which is H3. It's possible, but I think I actually got that one right. I do make many mistakes. All right, questions? Other questions? All right. Assumption for interest expense. When we do an enterprise DCF, one of the things the book talked about is how we choose a target capital structure for the firm when we do an enterprise DCF. And therefore, the capital structure doesn't really change over time. Now, here's how we're going to play out the assumption. So therefore, whatever the current capital structure is, it's going to stay about the same. So therefore, the company's not going to be forecasted to issue any new debt. So whatever debt they have, they're going to keep. Whatever interest they have, they're going to keep paying. So for the interest expense as a starting assumption equals the previous year. Right? Now, I could do a forecast. I could create another assumption for interest expense as an assumption. And I could do it as a cost of debt. Interest is percentage of debt. But I'm going to tell you it does not matter to the valuation model. And you'll see when we get to the valuation itself that the forecasted interest expense has no impact whatever on the valuation. So I'm just really putting in a placeholder for interest. I'm keeping it simple. So equals the previous year. All right. Same thing for foreign exchange gains and losses. 0. Right? And the reason why I'm going to say 0 is in today's world, most companies hedge. So therefore, it's going to be too hard to forecast whether or not in the future they're going to have gains or losses on currency. And so we're going to assume that most companies will be sort of currency neutral on a go-forward basis. Again, if we felt it was important to forecast, we could. But once again, you'll see a little bit later, it will have 0 impact on our valuation. Okay? So we're not going to put gains and losses on foreign currency. Non-operating gains and losses equals 2014 revenue times ratios 2014 net non-operating gains and losses as a percentage of sales. So we're forecasting a gain of 107 million. Pre-tax income equals operating income minus those 3 things. Minus interest, minus foreign exchange, minus net non-operating losses and gains. That would get us our pre-tax income. Again, just following the format over here on the left. Yes? Should you do what for interest expense? You mean that as the previous year? You could, but I'm just telling you that the practical impact is it will have nothing to do with our valuation. So it's not really anything you need to change. Next, income tax expense. Well, here's what we're going to do for that. We're going to take equals our pre-tax income, and we're going to multiply that by, from our ratios, our tax rate. And our income before extraordinary items will be our pre-tax income minus income tax expense. So that will be our forecasted pre-tax income. So income before extraordinary items is the next line item. So now we're going to forecast extraordinary items, extraordinary loss. Now here's the key word, extraordinary. Extraordinary items are non-recurring items. That's the whole definition of the word extraordinary. They don't happen again and again. So therefore, since these are one-time items that shouldn't repeat, we're not going to forecast one-time items that shouldn't repeat in the future. So extraordinary items, 0. Okay. Next, minority interest. Since we're keeping the capital structure constant, target capital structure, if a company still has minority interest, they'll keep the payment of the minority shareholders constant, equal to previous year. Net income equals income before extraordinary items minus extraordinary loss minus minority interest is our net income. Next line item. Total cash preferred dividends. We're not going to forecast any changes in dividends if we're going to keep our capital structure pretty constant. So whatever dividends they're paying, they're going to keep paying. Therefore, total cash preferred dividends equals previous year. Now Starbucks doesn't have any preferred dividends, that's why it's 0. But if they did, they'd keep paying the preferred dividends at whatever preferred rate they're currently paying. Other adjustments. These are basically accounting adjustments to the financial statements. Right? After-tax accounting adjustments. Again, we're not going to forecast accounting adjustments in the future. They also will not have an impact on our valuation. So I'm just going to leave those as 0. Okay. Net income available to common shareholders equals net income minus the dividends minus the other adjustments. Abnormal gains and losses. Even though Starbucks has had abnormal gains, which are one-time gains, for 6 consecutive years. The definition of the word abnormal means they shouldn't happen all the time. So again, it's too hard to forecast abnormal gains and losses, especially if they're not supposed to happen all the time. So we're going to forecast those as 0, even though they've happened for 6 consecutive years at Starbucks. Right? But again, if you have an abnormal gain, it's a one-time gain or loss, they're not supposed to be recurring items, so we're not going to forecast them as recurring items. That gets us what we'll call the normalized income. Equals net income available to shareholders minus, or sorry, I guess it would be plus abnormal gains. Dividends paid equals the previous year. Whatever dividends they're paying, they're going to keep paying. So because the dividends are coming in as a negative number, just a Bloomberg convention, I know it says normalized income minus dividends equals change in retained earnings, but what we're going to do is we're going to take the normalized income plus the dividends, because we're adding a negative number to get change in retained earnings. So change in retained earnings for Starbucks, 1108.6. Questions about what we just did? All right, so in the reading for the book this week, it talked about how long we need to forecast for, was the length of our forecast period. And the answer to that question is not a specific number, right? So ideally, what we want to do is we want to forecast a long enough period of time, explicitly, year by year, so that when we get to what's called the continuing value period, we can use the key value driver equation in our continuing value forecast. And at that point in time, the company should be mature. So because the key value driver formula is really 4 numbers that is going to be very sensitive to slight changes in those numbers into perpetuity, we don't want those numbers to have large adjustments to them. And so when they're going to have less adjustments to them is when the company's mature. Because when the company's mature, then essentially those numbers are going to be pretty predictable over time, and they're not going to be changeable as much. So the idea is that we want to forecast enough years of what I'll call the defined forecast period until the company's mature, and at that point go to continuing value. So let's say that I'm doing CSX, the railroad. If I'm valuing CSX, the railroad, I probably need to go 3 to 5 years, and then I can go to continuing value, and I'm probably pretty good. Right? If I'm doing Netflix, I might have to go 15 or 20 years before I think Netflix is a mature company. Right? Because it'll be a long time before they're a mature company. Right? So that's really the point. The answer as to how many years I have to forecast really depends on the company that I'm valuing. And I want to put continuing value, ideally, when the company's in mature phase. So, for this class, since we're going to be focused on primarily valuing bigger companies, too harder to value startups with uncertain futures in this short class, what we're going to do is we're going to arbitrarily, keyword arbitrary, forecast 10 years. Okay? So in our model that we're building, we're going to go out 10 years of explicit forecast period, and year 11 is going to be what's called the continuing value period. Or in the formula for continuing value, T plus 1, sub T plus 1 is year 11. That's the first year of the continuing value period. So here's what that means. I need 11 years worth of data, 10 plus 1, 10 forecast years plus 11 continuing value years, So I'm going to go out to 2024. So I'm going to go back to my ratios tab. I'm going to copy column H, and I'm going to paste it out 10 more years to column R, which gives me 11 years worth of forecasted ratios for the income statement. Questions about that? Then I'm going to go to my income tab, and I'm going to take 2014, the year that I just forecasted. I'm going to copy that. I'm going to paste that out to column R, and that's going to give me 11 years. Make this a little wider. Of forecasted income statements going out to 2024. So very quickly, we've just basically forecasted out 11 years worth of income statements based on 11 years worth of ratios. Now again, don't do this, what I'm about to do, because I just want to show you an illustration of later. But notice that if Starbucks keeps growing at 12% a year, by 2024, there'll be almost $52 billion in revenue. If Starbucks growth rate changes to 6% a year, then by 2024, there'll be $28.3 billion in revenue. So that's what we're setting up with our ratios, is eventually we can change the ratios and it will update these income statements, right? Right now as a placeholder, we're just leaving everything being equal to the 2013 ratios for Starbucks. But as I said, we will change that later once we finish building out the basics of the model. Right? Questions about what we just did? By the way, what's the economic version of the statement called? The reconverted income statement is what? TII. I go out to my TII. This is my TII. I've done the historical one for you. So here's all we have to do. Since everything is a relative reference and mapped to the Bloomberg Standard financial statements, I copy and paste this out to column R. And there is my forecasted TII. Notice it balances through 2024. Just change my relative reference years equal previous year plus 1. Copy and paste out the years. So I also have my forecasted TIIs. Forecasted income statements give me forecasted TIIs. All right. Our next statement is the balance sheet. And I'll go back to the ratios. Just as we use ratios for the income statement, we're going to use the ratios to help us forecast the balance sheet. Now, these 9 balance sheet ratios are the ones that I have chosen for us to forecast. If you wanted to do a couple more ratios, you could, but these are the ones that I think are the most important for us to forecast. Now again, here's where we're going to, for simplicity, diverge a little from the book. The book talks about this week, when you forecast a balance sheet item, you should forecast it based on the income statement driver. Okay? So, for example, if I forecast accounts receivable, the driver of accounts receivable should be revenue. So I should tie it to revenue. However, if I forecast inventory, inventory should be forecast based on cost of goods sold. Because cost of goods sold is where inventory eventually gets expensed. So the driver of inventory should be cost of revenue. Same thing for accounts payable. Accounts payable is primarily based on unpaid inventory, so therefore for suppliers, so therefore my driver for accounts receivable should also be cost of revenue. However, what we're going to do is we're going to forecast the entire balance sheet as a percentage of revenue. We're not going to tie it to each individual driver. We're just going to tie it all to sales. Right? So practically what that means is for 2014 equals the previous year. Make it yellow. And we're going to copy and paste that all the way down. Equal the previous year. Now, the reason we're doing this, there's actually two reasons. One, it's easier, and it doesn't really make a difference to our model because we're still forecasting the balance sheet as a percentage of revenue as opposed to a percentage of the items. And what I'm telling you is the percentage of revenue versus percentage of items, since we're dealing with operating items, it doesn't matter as much because the whole idea is that as revenue increases, the balance sheet increases. Right? So what we're really doing is we're tying the balance sheet to revenue, and so we're tying it to an operating driver. Right? And it's easier to forecast revenue, and the forecast, everything is percentage of revenue versus percentage of the other items, is not going to make that much difference in our balance sheet forecast. The other advantage of doing it this way is as the company grows, the balance sheet grows. As the company shrinks, the balance sheet shrinks, which means that there's an implied productivity that we're forecasting for the company. And if we forecast everything as a percentage of revenue, the implied operating productivity stays about the same. Because basically if you grow, you need the same amount of balance sheet to grow as you currently have. Therefore, what we're really saying is the operating productivity is not changing for the firm. Right? Now later, we could choose to change these ratios and change our assumption of productivity. But if nothing else, what's behind this is that the operating productivity stays the same. Right? And it's just a simplifying assumption, given that margin times cycle time, margin times productivity equals return on invested capital. We're kind of playing that out in the way that we're building out the forecast of the balance sheet. Right? So back to this. These are the 9 ratios that we are going to forecast for the balance sheet as a percentage of revenue. So now what I need to do is I need to go to the balance sheet and actually start creating my balance sheet forecast. So I go to balance, and just like the income statement, I'm going to label my forecast period so that when I print this out, I can differentiate between historical and forecast data. Equals previous year plus 1. And now I need to start out with the items in the balance sheet. The first one being operating cash. Now this is going to be as a percentage of revenue. So here's the deal. Equals 2014 revenue times assumptions operating cash as a percentage of revenue. 2%. And I'm going to take my whole balance sheet column here. I'm going to format it as currency to 1 decimal place. Just to be consistent. Now here's the thing. If I copy and paste this out, it's going to go to 0 because unlike the ratios, where I'm going to forecast ratios for a decade, for the assumptions, I only have one operating cash number for my entire model. So I can't really copy and paste it out in Excel because using relative references, it's going to keep looking for these cells here, and the cells are 0. So therefore, it's going to create a forecast of 0. So let me clear these contents. So here's what we're going to do. We're going to make the assumptions B3 an absolute reference, which means in front of the B we put a $sign character, and in front of the 3 we put a $sign character, what used to be called a string in Lotus 123 back in the day. But basically, assumptions B3 becomes assumption $sign B, $sign 3, or string B, string 3, which means to Excel absolute reference. It means always use that cell no matter where you cut and paste. So I'm going to make that an absolute reference. Now, next line item that we're forecasting on the ratios is accounts and notes receivable as a percentage of revenue. So on my balance sheet tab, I go to my accounts and notes receivable equals, from my income tab, 2014 revenue times, from my ratios tab, 2014 accounts and notes receivable as a percentage of revenue. Next, inventories equals, from our ratios tab, 2014 inventory times income 2014 revenue. I can go either way. Next, other current assets equals income tab 2014 revenue times ratios 2014 other current assets. The next one is long-term investments equals ratios 2014 long-term investments as percentage of revenue times income tab 2014 revenue. The next item is net fixed assets. So I go down here to net fixed assets, ratios, net fixed assets as a percentage of revenue times income 2014 revenue. Next one is other long-term assets equals ratios 2014 other long-term assets times income 2014 revenue. Next one is accounts payable equals accounts payable as a percentage of revenue times income 2014 revenue. Other short-term liabilities equals, from the ratios tab, other short-term liabilities as a percentage of revenue times income tab 2014 revenue. And other long-term liabilities equals, from the ratios tab, other long-term liabilities as a percentage of revenue times, from the income tab, 2014 revenue. So what we've quickly done is we have forecasted out 2014 9 ratios off the ratios tab and the 10th ratio operating cash off the assumptions tab, all as a percentage of revenue. Now what we have to do is we have to finish balancing the balance sheet. Finish the forecast of the balance sheet, but it's got to balance, right? And, very important, we can't create a circular reference. If you have a circular reference in your model, you have a flawed model. Okay? So we must finish up the balance sheet without a circular reference. So I'm going to show you how to do that. So in this case, we're going to start out by finishing the liabilities and equity section of the balance sheet. Right? So start out with equity, preferred equity. Since we're leaving a target capital structure for the firm, we're not going to issue or pay off any preferred equity. So equals the previous year preferred. Minority interest equals the previous year minority interest. We're not going to issue shares equals the previous year share capital. So the final part is retained earnings. So here's how retained earnings will work. Equals previous year retained earnings plus, from the income tab, 2014 change in retained earnings, which is income minus dividends. So that's how much our retained earnings should go up. So we're going to add that to previous year's retained earnings, and that will get us our ending retained earnings balance. So it does equals previous year retained earnings plus, from the income tab, 2014 change in retained earnings. I know this says common equity. Probably should say total equity. is the sum of those four things. That would be our total equity. Bloomberg calls it common equity, but it's really total equity. Right? So, preferred, minority interest, share capital, and APIC, additional paid-in capital, and then retained earnings and other equity. You add those four together, that's the total equity of the firm. Next, liabilities. If the company has any short-term debt, we're going to leave it alone, equals the previous year. Because again, we're not going to issue or change any capital structure related to the debt, so we're not going to issue or pay off any debt. We're just going to leave it out there. Right now for Starbucks, they don't have any short-term debt. Total current liabilities, those are the sum of the three above it. Long-term borrowings, same thing, equals previous year's long-term debt. Pension liabilities equal previous year pension liability. They'll still have the pension liability, but it's not going to grow. Because under U.S. accounting law, companies are not allowed to run long-term pension deficits. So they're not going to have any pension deficits going forward. If they have one, they'll just have whatever they currently have. It has to be paid off. So long-term liabilities are going to be the sum of the three above it. The long-term borrowings, the other long-term liabilities, and the pension liabilities. Total liabilities equals long-term plus short-term or current. And liabilities and equity equals total liabilities plus total equity. And I still want to double check this number because this looks like an odd number here. Guess it is what it is. All right. So that would be the total liabilities and equity for Starbucks, approximately $13.3 billion. Now, here's how we're going to get the balance sheet to balance. We're going to force it to balance. We're going to take total assets, and we're going to set that equal to total liabilities and equity. Balancing balance sheet. Now, in order for the balance sheet to truly balance and everything to add up, that means we have to create the concept of what is known as a plug. We're going to have to solve for something in order to continue to have the balance sheet balance. Our plug is going to be excess cash. So what we're going to actually solve for to get the balance sheet to balance is excess cash. So we need to finish up all the asset line items so that we can solve for our excess cash. So in this case, current assets is a sum, so I don't need to worry about that. Gross fixed assets and accumulated depreciation. Gross minus accumulated depreciation equals net. I've already forecasted the net, so I don't really care about the gross, to be honest with you. All right, because the number that we care about is the net fixed assets, and so since I forecasted that one, don't need the gross, don't need the accumulated depreciation. So really, the only line item left that I need is goodwill. It's too hard to predict when companies are going to do acquisitions in the future. So therefore, we're not. We'll assume that most acquisitions are close to NPV 0. Actually, most acquisitions lose money. They're probably NPV negative. But in this case, we're not going to predict any acquisitions because it's too hard to do. So therefore, the goodwill is just going to stay the same. Equals the previous year. Now, we can plug for excess cash. What is excess cash? Equals total assets minus everything else. Minus operating cash, minus accounts receivable, minus inventories, minus other current assets, minus long-term investments, minus net fixed assets, minus goodwill, minus other long-term assets. So I basically took total assets, subtracted everything else, and what's left is excess cash. And very importantly, no circular reference. Final step, take my current assets, I can now sum those up. Take my long-term assets, I can now sum those up. Double check equals long-term assets plus current assets. And they equal my total assets. Get rid of that cell because I don't need it, but that's the point. I now have a balancing balance sheet. Forecasted balancing balance sheet. Questions? All right, so I go back to the ratios tab. I take my ratios for the balance sheet, copy them, paste them out 11 more years to 2000 or 10 more years to 2024. Go back to my balance sheet tab, take my 2014 balance sheet, copy it, paste it out to 2024. I now have a forecasted balancing balance sheet for SBUX going out to 2024. Economic statements, go back to TFI. TFI is my rearranged balance sheet. Again, these are relative references where everything balances. So I just take my TFI, copy it, equals previous year plus 1. I now have a forecasted balancing TFI that goes out to 2024. CFI. I'm going to take 2012 and copy this because there's a missing relative reference in 2013 and paste this out to column R. And I have balancing CFIs that go out to 2024. The only thing that I'm missing is my years. I think I screwed up the years when I did that because I wiped out, what was the first year? 1, 2, 3, 4, 5. 3, 22, 21, 20, 19, 18, 17, 16, 15, 14, 13. So this was my first year equals, I'll just get off TFI. Do it this way. Equals C. There we go. Wiped out my years by mistake. But the important thing is I have forecasted years going through 2024. Now you might notice this strange total category at the end. If you remember when last week we did the 5-year historical CFI analysis of the sum, that's the total giving the sum. So that later what we'll do is we'll hide, not delete, but we'll hide those, and then this will give us the 5-year CFI analysis and the totals of the 5-year. Just let the totals in there, make it a little bit easier for you. But for now, I'm going to unhide this just so you can see the whole thing. Economic profit. If it was there, you could leave it. If not, copy and paste it out to column R. Equals previous year plus 1. Here's my forecasted economic profits through 2024. And based on beginning of year data, and here is my economic profit through 2024 based on end of year data. Economic profit beginning of year, economic profit end of year. So again, a little over an hour. We have forecasted the income statement, we have forecasted the balance sheet, we have balancing economic statements that go through 2024. And we've set it up so that everything is based on changes in the ratios tab. So as we change the ratios, it will change the model. Again, questions? About what we've just done. All right, here's a question for you. Think of this as a midterm exam question. CFI. If you look at the out years, starting in 2014 and then 2015, actually I want to do one other change. From the income tab, or the ratios tab, for the tax rate, starting in 2015, I want to equal the 2014 tax rate. So equal the previous year and then carry that on. Because that 5-year average is getting screwed up by the tax rate of 2013 showing up in that 5-year average. And the same thing for net operating gains and losses. 2015 equals the previous year. Copy and paste this out all the way through. So my non-operating gains and losses don't change. So I use the 5-year average to get the 2014 number. 2015 through 2024 equals 2014 number. So back to my question. CFIs stay constant from 2014 through 2024 at 648.5. They don't change for 11 years. Starbucks is growing, it's getting bigger. Why isn't the CFI changing? We got 11 years of CFI that are constant in our model. Why is it constant? Yep.
Maybe because everything's in proportion to revenue.
Partially everything's in proportion to revenue, but why isn't the CFI going up in proportion to revenue if everything was in proportion to revenue? What is CFI again? Cash flow available to investors. So what is it? In sort of plain explanation. What is CFI? It's the cash flow available to investors But what is it? What is the cash flow available to investors? What does it really mean?
It's the cash that the company paid to investors.
It's the cash that the company paid to the investors. Now, what assumption did I keep saying we're making about the balance sheet? Constant capital structure, which means we're doing what to the payouts? We're keeping the payouts the same. We're keeping the interest the same. We're keeping the dividends the same. We're not issuing or retiring any new debt. We're not paying off any shares. We're not buying back any stock. We're not issuing any new stock. So that's what you see here in the CFIs. The cash flow to the investors is not changing. The interest expense stays the same. The minority payments stay the same. The dividend stays the same. There's no change in debt. There's no change in equity. So therefore, the cash flow available to investors stays the same for all 11 years. Now, back to the other point that was just made, the company's growing during all this period, and the company's generating more and more cash profits. Where is all that cash going? Excess cash. You'll see that the excess cash balance continues to increase year after year after year, so that if we look at the balance sheet, the excess cash balance gets to almost $26 billion. Right? So here's the thing. In this model, we're not directly forecasting dividends or stock repurchase, but in this model, we're forecasting a proxy for the dividends and the stock repurchase, and that's called excess cash. Because if you remember, free cash flow, operating cash flow, equals what theoretically could be paid out. And if we don't pay it out, what happens to the excess cash? Or sorry, what happens to the cash? It shows up in excess cash. So excess cash is the discretionary cash that can be paid out. You can use it to buy back stock. You can use it to pay off debt. You can use it to pay interest expense. You could theoretically use it for more acquisitions, which would show up as more operating capital. But that is the cash that truly is excess that can be paid out. So in a way, we are forecasting future stock buybacks and dividends. We're just not forecasting it year by year. We're forecasting Starbucks' ability to do that, which is its excess cash. Right? So again, this model actually tells you what a company can pay out. Right? How the company chooses to pay out, that's difficult to predict, because the company could choose to increase its dividend, or a company could choose to buy back a lot of stock, or a company could do both, and we don't have to worry about that. We know that it has cash available for either one, and then that's just the question. From a valuation standpoint, how the company chooses to distribute that, we don't know. We just know they have it to distribute. Right? That's, in a way, the world is harsh on Carl Icahn. But if you look at Carl Icahn is saying, look, Apple, you should buy back $50 billion worth of your stock with your excess cash because you have $140 billion worth of cash. You don't need all of it for operating cash, right? 50 billion is clearly excess cash out of 140 billion. Get rid of it. Like if you're really saying you're not going to use it to run your business, why are you just building up this big war chest that you could eventually pay out? Give it to me now. That's basically what Carl Icahn is saying to Apple. Now, because he's saying it in a way that Apple doesn't like, Apple's not going to probably listen to him in the short run. But if you did read the newspaper last week, Apple did what with their stock? They bought $14 billion worth of stock in the last 2 weeks. So in a way, they are using some of the excess cash to buy back their stock. Now, Tim Cook's whole argument for why they're not buying back the stock is a tax issue. He's saying, look, we only have $30 billion worth of stock of cash in the U.S. $110 billion is outside the U.S. And if we take the $110 billion outside the U.S. and we repatriate it, we're going to have to pay a 35% tax rate on it. So we don't want to repatriate the cash and pay the tax rate until we can find a loophole that allows us to do that. So really, we only have $30 billion worth of cash, which is why we can't buy back 50. We would have to essentially borrow to buy back the 50, right? Because they don't want to take the cash from outside the U.S. and bring it back to the U.S. So that's actually the nuanced argument that Tim Cook is making. It's a real one because of where the cash really is, and Apple can't repatriate to buy back the stock. So Carl Icahn, by the way, is saying, go borrow the money. That's his response. Borrow the money against your foreign cash reserves real cheap and just give us a giant stock buyback. But that's not in Apple's DNA right now. Anyways, model's helping us understand that. So if we were to do Apple, and maybe we will, over the next couple weeks, we could quickly put in a different company, and that's the idea. This is a reusable model. So if we start with the process that we did at the beginning of class, where we went to Bloomberg and we got the financial statements for another company, we could literally overwrite the data that's in this model, and then within 10 minutes, have all the data forecasted for another company. Okay? That's where we're eventually going with this, right? But this is where we're going to pause with this model and pick up on Wednesday on our next class. So what we're going to do on Wednesday is we're going to finish the valuation. So we're going to take where we are in this model, and we're going to add 2 valuation tabs to the model on Wednesday. We're going to add what's called a DCF valuation, discounted cash flow valuation, enterprise DCF. And we're going to add the economic profit valuation. And we're going to do both of those valuation methodologies and add those to this model. Okay? So that will give us a per share valuation. And then what we're going to do is we're going to do 2 valuations of Starbucks on Wednesday. We're going to do what's called an as-is valuation. And then we're going to do what we call a final valuation. The as-is valuation is we're going to look at the current share price of Starbucks, and then we're going to try and change our model so that we basically get the current share price of Starbucks. So essentially trying to figure out on a cash flow basis, what is the world, what is the sort of financial world thinking about their assumptions for Starbucks that got to the current share price. Because the institutions are basically determining Starbucks stock price. What are the institutions putting in their models that got to the current share price? So we can essentially try and figure that out using this model. Then what we'll do is we'll do a final valuation, which is we'll put in our own scenario. Maybe we don't agree with the assumptions that the institutions have made. Maybe we think that they're too aggressive or not, or maybe too conservative. And then we can put in our point of view for what they should be. That creates the idea of a target price and a buy, sell, hold. Okay? So that's really what we're going to finish up on Wednesday. So by Wednesday, we would have finished a valuation, actually 2 valuations of Starbucks, what we'll call the as-is and the final valuation. Right? Now next week, you're going to have your midterm exam on Monday, and then on Wednesday, I'm going to give you another company, and what you're going to do is you're going to take that company and you're going to put it in this model, and then you're going to value another company, and that's going to be called homework 4. Right? So next Wednesday, we will do homework 4. Right? So next Wednesday for class, I'll give you another example. During class, we'll go through the process of putting in new data and valuing another company. And then next Wednesday, you'll have to do this yourselves. Okay? So again, hopefully you've been able to follow along and individually create what we've done in class, because you'll be using your model for that valuation. Right? So that's kind of a preview of where we're going for the next 2 weeks. So here's the final thing. This Wednesday, you need to have selected your teams. So there's 31 people registered in this class, so we need to have 5 or 6 teams. So either teams of 5 people or teams of 6 people. Okay? So no more than 7, but no less than 5. And I want you to divide up into teams on Wednesday. And if you're not in a team on Wednesday, I'm going to put you into a team sometime during Wednesday's class. You have between now and Wednesday to figure out your own teams if you want to be on a team. On Wednesday, I'm going to let you select a publicly traded company that you're going to do your group project on. Okay? So Wednesday is group project selection day. And remember, this is 1/3 of your semester grade. Right? It's going to be the team-based project you're going to be working on. So pick people that hopefully you want to work with. But again, everybody needs to be in a team. So if you're not in a team on Wednesday, I'm going to assign you a team on Wednesday. So that's what we're going to do on Wednesday's class. Questions about that? Yes? You will need to use the computer for the midterm exam. And so pretty much I would say, I would assume you're going to need to use a computer for every class for the rest of the semester. Because you're going to be, when you're not doing the midterm, we're going to be doing a lot of Excel work in class as well. Because we're going to continually practice on valuing different companies and doing analytics that comes out of these valuations. All right? Other questions?